All right, so thanks for joining us on our last session here on Fast Casual Global. Today, we're going to wrap it up, I think, with kind of a topic that a lot of our listeners, viewers, and audience have really asked about, and that is kind of how capital is working in the market and how it's affecting kind of this rebirth of where fast casual restaurants are going. And of course, with me today, I've got Mr. Chad Spaulding, who's a managing director over at CapitalSpring. Great to have you. And also Jim Balis from CapitalSpring, also a managing director and strategic operations there. Guys, welcome to the session. Appreciate you stopping in.
Thanks for having us.
Thanks, Paul.
Absolutely. So let's get into a little bit about CapitalSpring. Chad, I'll kind of direct this at you. For our audience that maybe they don't know a lot about it, kind of give us the elevator pitch on what you guys are all about.
Sure. So CapitalSpring is a dedicated restaurant investment company. That's all we do. We've got about $2 billion dedicated specifically to the industry. Our motto, or our reason for being, is to support experienced operators as they go out and grow their concepts or their restaurant operations. We have about 3,000 restaurants in the portfolio, about a third of which we operate ourselves. We've been around for over 15 years. That experience has been good for a group like us because we've been maniacal about data, about collecting best practices, about really being students of the industry as we've collected data over those years and built up our own portfolio. So what we try to do is bring a ton of resources. We have a full ops team, which is why we're so lucky to have Jim Balis here with us today. He's forgotten more about restaurant operations than I'll ever know, and he brings those resources to our portfolio. So, of the restaurants that we operate ourselves, he sits atop of all of those. He and his team have gone out and talked to something like 400 or 500 different service providers within the industry. They've interviewed them all, most of which they've tested. We've got pricing, everything from credit card processing to site selection that we can apply back to our portfolio and offer those resources up. We operate like a big restaurant company. We're structured like a fund, but all of us here have only ever done restaurants in our careers, and that's the way we think of ourselves. So, we try to really differentiate from kind of other capital providers in terms of the experience that we bring to the table, the resources that we bring to the table, and even more so in terms of the capital products that we can do. So where many investors are focused specifically on private equity or some type of structured capital or senior debt, we can provide any of those things. And we do that in a way that creates some creative and non kind of conventional capital structures for companies that need something that is not conventional. And that's really what's kind of propelled us to where we are today, is being able to provide that. And so that's CapitalSpring, I think, in a nutshell.
So Jim, let's jump over to you a little bit operationally. When you are kind of looking at the number of brands in your portfolio that you're working with, obviously the first thing you have to do is kind of assess the leadership team, kind of what's happening within that organization. What are some of the things you're looking for in operations, whether it be fast casual, casual dining, across the spectrum there, to kind of establish, hey, this is a great leadership team that we can grow with?
Yeah, look, there's a lot of challenges out there today. I think from our perspective, we look for leaders that really build great teams and great culture. And I know that's a little bit cliched to say, but, the power of a group that works collaboratively is always so much stronger than the power of one. Teamwork makes the dream work, as they say. And so, we think that's, a very important piece of leadership and leadership teams, those groups that are, developing and surrounded by great leaders, so that as a collective group, they can arrive at the right decisions for the company. Obviously, forward looking is critical to us. It's important that, that leaders look at what are the challenges today and what are the challenges a year from now and 5 years from now, and how to prioritize objectives, capital deployment, team bandwidth, everything that is restaurant operations related, really ties into the broader strategic initiatives that are laid out in the short and long term. And so, finding those leaders that are able to, see it from that perspective and really develop those, broader objectives, is important. And then, those that can be very nimble and flexible. I mean, we're dealing with a pandemic right now. Historically, whenever something was thrown at us as leaders, we were able to, look back at some experience that we've had, and, what we're dealing with currently is something that we've never seen. And so it's important that, leaders can be flexible and adapt and not just apply, their same sort of tools from their toolbox, but, are open and looking to, how they can be more nimble. And, those are some of the basics, other than, obviously, great leaders are great communicators and, other characteristics. But, within the restaurant space, that's what I would point to.
Yeah, for sure. So in terms of how CapitalSpring goes in and works with either, an investment, opportunity, or, someone that you're working on strategically, for you guys to kind of take a step with that, and maybe this goes back to Chad on a question here. How do you make that determination of whether or not this is a good fit for yours? Because in likelihood is, for those who are listening or watching, they probably are in that kind of same position. They're probably either shopping capital or looking at investment opportunities into their business. What is it, though, on your side of the table that you guys really look for in a brand when you look to engage with them?
Yeah, and Jim, you can jump in on this as well. We have the benefit, I think, and sometimes the burden of looking across all categories within the restaurant industry. So we, are opportunistic in terms of where we're looking. We're not closed down to casual dining right now, like many are. We'll evaluate that. We'll look at it. Obviously QSR and fast casual are all places that we've spent time. So, the things I think that you generally look for, somewhat cliche, but you're looking for, as Jim said, great management teams with the ability to pivot with a concept or a brand that actually allows them to pivot. So lots of diverse channels. If you, and we've seen this now through the pandemic, but if you, get shut, your dining room gets shut down, you pivot to digital. If breakfast gets taken away, you've got a lunch and a dinner day part that you can push to. Having moves within a concept and having a management team that can actually execute on those moves is now, I think, going to become very important, because the pandemic has certainly been something that's shaken, the world, but the repercussions of the pandemic we expect to last for years. So people are going to need to be very nimble going forward, and stringent type of concepts that aren't built to give options to the management team are going to have a hard time keeping up with the needs going forward. So, we look for that. We look for, great operating leverage within these businesses, meaning, businesses that aren't built around, brand building, A+ real estate with extremely expensive rents, small footprints, small peak hour labor, so that you can really generate incremental sales and have those sales kind of flow through to the bottom line. And I think those are going to be the things that we continue to look for. There's always exceptions to those rules, and there's great concepts that don't necessarily have all those things, and we're open to all of them. But, those are certainly some of the more attractive characteristics coming out of the pandemic and thinking about the future.
Jim, from a aspect of operations for fast casual, one thing that we've started to see, obviously, this big move towards digital was kind of already in the process of being a huge representation of how the industry was kind of moving forward. And some of the recent data that we've seen in terms of sales numbers, year over year, operationally, we're starting to see some growth in these categories, especially the top 150 fast casual concepts. We've seen really positive numbers coming out of that sector. And there are those, both on analysts and even on some of the data that we're running, is that we could see a huge boom in the shift of digital actually grabbing more occasions away from, what used to be grocery and cooking at home and some of those things. This pandemic has actually repositioned how the consumer is buying food. So if you look at that operationally for operators that are trying to deal with the pandemic, but also deal with growth, especially in this digital phase. Are you seeing any kind of major brands that you guys are working with that have done this really well, or maybe some that are struggling that are trying to make steps to move into that next phase of potential growth? Where are you guys on that?
I mean, I'd say, there's a lot of brands out there that are doing a great job managing through the digital process. I think, where it shifted, and as we try to think ahead coming out of the pandemic, that we need to all prepare ourselves for is, what happens when we start getting some of the dine-in customers back, balancing that
Right.
with the continued, the digital situation. And so,
Yeah.
the trick's going to be that as we return to normality, I think we've gotten a little bit of leeway on peak periods where people are, not going to an office, and therefore 11:30 to 1, for a lunch period, for example, that you may experience very high volumes in a very short period of time, and it was all about managing throughput during those 90 minutes. We've had a little bit of a luxury here of people flexing those meal period times. I think when people come back and begin to return to normality, we're going to see some of those peak periods return, balanced with all the digital orders coming in. And so now
Right.
you're going to have to figure out operationally how to manage that throughput. And I think one of the key elements of that operationally that we're looking for are brands that are able to really apply, whether it's technologies, analysis, and other sorts of action plans, and even robotics in some cases, to manage, both the digital and dine-in sales when those return during those peak periods. I think a number of the brands are very aggressive in looking at how to manage through that. And then obviously all the digital channels, like, through apps, third parties, those that are able to do and able to integrate with the Alexas of the world, and
Yeah.
a lot of the other social media channels for ordering. I think that's going to become more prevalent, and so the brands that are able to really take advantage of that, monopolize on those opportunities, are the brands that are going to be successful going forward.
Yeah. Well, and that's the, kind of the forward thinking. There are quite a few brands that we've watched here in fast casual that have started to separate from the pack. It's kind of the haves and have-nots. So there may be some opportunity for some of those brands to get some, guidance from teams like you and others out there to kind of get them in a position where they can pull forward and deal with this. Chad, when you guys are looking at, imagine if you look, whether it was fast casual or even a casual dining concept, and they are moving heavy into digital, and they've chosen the route to really advance on ghost kitchens, maybe a virtual brand presence. What's your position on that? How do you guys look at ghost and virtual brand living inside the restaurant space?
Yeah, and I think I'd be curious to hear what Jim says about this too. But listen, I think the ghost kitchen concept was something pre-pandemic that was growing very quickly,
Right.
and I think there's good reasons for that. A ghost brand without brick and mortar is a totally different business than a brick and mortar business on the retail side.
sure.
It takes a lot of brand building on the digital. It's very expensive to actually create a footprint that you can build around a brand around when you're competing for space on clicks. And so, it has become, especially through the pandemic now, very crowded. And a lot of people we were able to do that, and Jim's led a lot of those efforts within our portfolio. We were able to use what would have been vacant kitchen space in dining room heavy type concepts with ghost kitchen type brands that really allowed us to bolster and supplement the kind of revenues and cash flows that were coming out of those units. But a lot of other people did that as well. And coming into a more normalized area, I just wonder how crowded that business is going to be, and how many of those brands stick around. So while I think there's a lot of good reasons for it, I think you've really got to be careful about the growth projections around that particular strategy on its own.
Yeah, for sure. And, we're seeing the same kind of thing in terms of the numbers. It's kind of flooded the market. It'll be interesting to see how they can hold up, beyond the growth of digital. If digital is going to continue to see the kind of growth trends we have right now, it's a good possibility these guys could really stay on track. I mean, we've talked to Andre over at Doghouse many times, and he's really all in on what they're doing with multiple brands under one. Yeah. And I've been kind of impressed with what their moves are. Jim, what are your thoughts on virtual kitchens, Ghost? You guys are running some in your current operations?
Yeah, we are. Some of them are brands that exist elsewhere that we're, either licensing or, quasi-franchising. In other cases, right. We've developed our own brands. I think what you're going to see, and this is just, perhaps, my personal vision of where some of the ghost kitchens are going to go, is you're going to see, trying to leverage the same products within different concepts. And so, right. So for example, you might have developed a burger concept and given it some sort of branding that might appeal to, how many, that might appeal to a demographic that, let's say, is a millennial demographic. And you might take that same product and sort of rebrand it to appeal to a boomer, based on the food shots, the brand name. Yeah. So I think we're going to start to see, and again, this just may be my vision and what we're trying to do here, so that you're not polarizing for a specific product, because, as people sift through on their phone and look, click the hamburger link on one of the third-party providers, right? One brand may appeal to them, to one set of demographic versus another. And, we're trying to leverage as much as possible, sort of getting back to your question, out of that single kitchen. So if we can produce, a bacon cheeseburger and call it something that's zombie related that may appeal to, zombie lovers. And then on another side, talk about something that's, very heritage in nature that might appeal to somebody that's a little bit older. We can leverage, that same product, that same kitchen in multiple ways and try to create incremental revenue from, a single initiative.
I like that approach. I think that's, I've seen a couple of companies that have started to do that. Smoky Bones down here in South Florida has kind of moved in that direction to kind of look at demographic matching with menu. And I think it's a pretty good strategy, considering that we are seeing kind of a bit of a separation right now from the boomer generations and their dining habits away from what we're seeing in the millennials and Gen Z, which is going some different tracks. So that definitely could flow very well in that. Your thoughts, and I want to kind of get both your thoughts on this, and that is with we've talked about this on a couple of sessions here in Fast Casual Global, this whole approach toward vertical integration from the third-party companies, meaning they're getting into restaurant operations, they're getting into other direct-to-consumer delivery models. Acquisition of Drizzly by Uber kind of shows that direct-to-consumer move, even though they do have retailers. What are your thoughts on these third-party companies getting into the restaurant space and circumventing what's happening there in the restaurant sector?
Go ahead, Jim.
Can be good.
Yeah, certainly it's a threat that can be very challenging. I mean, these companies are very well capitalized. Right. And what they're doing is they're taking the data that they have, because they're understanding, what the consumer preferences are, everything from spend to day part to product mix, and applying that data that we don't have access to, and trying to develop a successful restaurant strategy. So they definitely have, an upper hand in that regard, and could pose a threat. We're seeing some interesting startup companies now that are actually developing a fully integrated model where it's multiple menu offerings within a single kitchen that's very small. So utilizing a lot of the latest and equipment technology that has 100% integrated system. So they're the order comes in, they know how long it takes to prepare each item. They're able to, they have a KDS system that's telling the cooks when to fire certain things so that the food is completed all at the same time. The delivery driver's already there waiting, and, is taking the food and, within, call it 12 minutes, 13 minutes of being completed, it's in the consumer's hand. And so I think, that's where the delivery companies are aiming to be, I think, where they're going to be fully integrated to have the, everything from order through to delivery. Right now, there's a disconnect with all of the restaurant companies where, we make the food, it sits there. And one of the big challenges we have now is, the DoorDash drivers taking two orders or taking an order from DoorDash and Uber Eats. And, they're not swiping their DoorDash app that they picked up the order until the Uber Eats order is ready. Then it compromises the integrity of the product. And, it's just an issue that we're having to deal with. Once these companies develop fully integrated models, they're definitely going to have an advantage. And so it's how we react to it and develop our own integrated models is going to be critical to compete with those.
And that is go ahead, Chad. I think you were going to add to that.
Yeah, I was just going to say, it just kind of comes back to what we said earlier, which is, it's a crowded space as is. And some of the people that are going to come and build brands around that segment are going to be extremely well capitalized, as Jim said.
Yeah.
And, a brand, you got to remember, this is the food business. Brands matter. And when the consumer has more confidence in a brand, or a brand is better, promoted with a big marketing budget, they're going to do better. And, if you can't compete with that going forward, I think you got to, again, really think hard about how hard you want to push into it.
Right. One thing that I found interesting, and we've kind of looked at this across our network many times, is the whole third-party leverage that they have in terms of just understanding the data, like you mentioned, Jim, in the sense that they can go out and purchase keywords, they can do some analysis on really kind of what's working. And Noah Glass mentioned something on one of our earlier sessions where he recommended when you do deals with these third parties, is actually do exclusionary kind of clauses that basically say, hey, you can't go out and buy my keyword, include my own brand keywords, and then rank above me or buy advertising above me and circumvent my own clients who are searching for me already. So there's a big kind of a big stretch for a lot of operators to really kind of understand how this goes. And you guys working in the space, you probably have maybe access to a lot of companies that you've seen insights. Don't want to name names, but have you seen anybody that has successfully put together their own delivery platform that they can actually utilize in their operation at a scaling level? Anything like that you've seen in the marketplace?
I can go first if you want, Chad. So, we have seen a couple, and, it ties into, some of the leadership question you asked about thinking, now and for the future. So,
right.
As these third-party delivery providers become more prevalent, the question becomes, should I just deploy delivery myself? And is there a way even to do both? So maybe, I try to attack everything within a 3-mile radius and then defer to one of the third parties beyond that. And then further, self-driving cars are just around the corner. There's been a couple of announcements recently about some of the major auto manufacturers, getting involved and putting a lot of dollars behind those. And with that, it makes you think very hard about self-delivery. If I can have a self-driving car deliver the product versus, having to hire somebody who could potentially get in an accident and liabilities associated with it, and just, staffing in general is a challenge these days, it just makes me think twice about it. And so, what we like to do is to think about, and getting back to your question, there are a couple of companies out there that as I had mentioned earlier, are looking at fully integrated platforms with their own delivery drivers, so that you don't need the DoorDashes and Uber Eats of the world. You're able to operate independent of those, and then you have the data, you have control over the integrity of the product, you have control over how long your delivery times are. It just gives you a lot more, control over your own business. And so, I think, as it moves forward, I think people are going to reconsider the model of, well, I just have to go to one of these delivery providers in order to have a delivered product, and look at some more creative ways, utilizing some technology that, enables companies to do it themselves.
I'm on board with you there. I think there is some huge advancements happening right now, especially in autonomy, that is, could be just around the corner for sure. This is interesting too, because if you look at the growth on third party and just digital in general, a $2 million fast casual restaurant that used to do 18% in takeout and delivery now is doing 60%, maybe 50% in some markets. But let's say that we continue to see this rise and we're at 60% now. My goodness, you're talking about $1.2 million that are going out the door per year, times a delivery fee, potentially, if you were all in on third party. That changes the dynamic dramatically, in terms of how much money you're spending in there. I can't imagine that an operator couldn't take that spend and reposition it in a brand case for developing a better relationship with their customer, especially at that kind of cost to do that. Chad, when you guys are looking at, because you've got, obviously you guys kind of pick your concepts that you work with. If you were talking to a concept right now that maybe is in either early stage or they're just in their first few years of growth, what would you tell a leader to say, hey, to get ready for either private equity or some funding coming down the pipe, these are the things you need to be doing? What would be some of the two or three things that you would say to leaders that are thinking a few years down the road?
Yeah, well, boy, it's so brand specific because, the characteristics of a brand and a concept, it really matters on how you think about your growth and where you think about your growth and the pace of growth. So, tough to have a conversation around that in broad strokes. But, look, I think, especially in fast casual, we have had, as a segment of the industry, and operators within that segment have had, I think, the fortune, maybe the curse again, of really high valuations and, a lot of white space, which brings investors to the table to give, huge valuations to these businesses. Huge valuations are great because you dilute yourself a little bit less. You may take a little bit more money off the table in the early stages of your business. But boy, then when you get, into the board meeting talking about execution on growth, what are your options and where do you go? And, a lot of those guys we saw, and I go back to these, brand building type leases that people set up, signing up a pipeline of 50 different locations, taking any lease you can, landlords firmly in charge of those leases. So you're signing up for double digit occupancy costs, even on $1,000 square foot type locations. I mean, that's a death knell. That's a recipe for disaster down the road when the inevitable volatility comes in the restaurant space to your concept. And it's really just a question of how long can you survive under that platform. So, I think the real estate execution of growth brands for investors, you've really got to be able to articulate what you're going to be doing. And remember, some of these segments, some of these, brand building DMAs, LA, San Francisco, Chicago, Washington, DC, New York, a lot of those demographics, people love to build brands in them because it's super dense. There's a lot of consumer spending. There's a bunch of different types of consumer demand, so you can build different types of concepts right next door to others and still be successful. I was having a conversation yesterday with a friend of mine who is in the office space acquisition business. And, he is confident that within those types of areas, we've lost 20 to 30% of spending power because people have moved and they're not going back into those offices. And fast casual brands specifically have built their locations around office space and campuses. And they're not going to have the same type of power on the P&L from their old pre-pandemic business as they will on the backside. And we've seen perhaps the greatest wealth migration of our lifetimes in the last 12 months. And what that means is these dense populations and DMAs that everybody wanted to build brands around now have been diluted to Boise, where Jim's at, to little towns like Rexburg, where I am. And it's going to be a very different growth strategy for these guys. And people have to be prepared for lower unit level economics. They need to be thinking about lower build out costs to be able to compete within those rural markets. And you don't want to be going into, again, A+ real estate, or what used to be A+ real estate in, hot urban kind of centers, because, with a big build out cost, you're just not going to get the returns.
Yeah. Yeah, for sure. And I think that's, it's been something that we've been looking at for some time here in the sense of just this kind of de-urbanization. A lot of what you were kind of mentioning in the fast casual stars really have kind of been reshuffled this year. Even on our top 100 list, I was surprised at seeing some of the players that started to rank up much higher, and it was based through consumer sentiment that we're seeing, and that's because there's almost a complete shift in the landscape of where the consumers are. So definitely agree with you guys on that. I want to get one last question to you both, and each of you can maybe answer on operations and capital. And that is, if you looked at one trend this year that you needed to see, that you really say this could be something we really need to pay attention to, what would you say it would be? Let's start with you, Jim. Operationally, where you see one trend that is like, hey, we really got to watch for this.
Well, I'm not a good student because I'm going to give you two answers versus one.
There you go. That's even better.
But, look, safety and sanitation is something that I think is here to stay. I think, there's been a focus on it, obviously, through COVID. And I think, is it going to be to the degree of what we face today? There's been, a lot of other, I shouldn't say a lot, but a few other pandemics that, or illnesses that, vaccines have come out for that people don't think twice about in retrospect. And so I think that's one item that again, not to the extent that we're experiencing now, but I think there's going to be a heightened awareness of in general. And then the other, I really believe is going to become more prevalent. We're starting to see it, especially with the announcement of minimum wage, is some form of robotics or automation. You look at the auto manufacturing industry, a lot of other manufacturing industries, and what they're able to do with the amount of precision they're able to do it. Just as technology is finally catching up to our industry, I think robotics too will eventually catch up with our industry. And you're going to see a lot more automation back of the house, just like you're seeing in front of the house with kiosks and digital ordering. The same thing's going to happen back of the house. So I think those are two, sort of trends that are here to stay and going to evolve over time.
Yeah. How about you, Chad? I mean, there's a lot of capital plays out there. You've got family offices getting into this market, private equity, venture is even looking at some of these bigger deals. You got big, 800-pound gorillas like Roar Capital. Where do you see the market going in terms of a trend for capital in the restaurant space?
Well, I mean, it's all about momentum in this industry. It's all about ROI. So, I think we have been at an influx in the industry for a long time where we've had saturated markets. We've had way too many doors relative to the consumer spending in those markets. And, that has stymied, a lot of the potential growth that's been out there. And I think caused, especially through the pandemic, a lot of people that put those high valuations on those growth concepts to lose a lot of money. So you've got a little bit of a burned investor base that's out there that doesn't necessarily believe in the growth potential of a lot of these brands anymore. Like I said, we've got one of the biggest capital overhangs in history for private equity family offices, as you said, strategic capital coming into the marketplace to spend money. So this whole growth dynamic and the conflicting forces between it will be interesting to see how it plays out. But I think anybody that's going to be trying to get a growth multiple has got to be thinking about, again, smaller footprints, small dining rooms, small kitchens, small peak hour labor forces, high flow through that you can really return your capital on and show it quickly. And small footprints, the other magical thing about it is you can grow faster. It takes less time to get into a new location and take advantage of some of the store closures that I think everybody's going to want to take advantage of out there. So, to me, it's not as complicated as the stuff Jim's saying. It's kind of a blunt force capital, type of a thing. But you've got to push down your development costs. You got to rethink your whole operating leverage of your P&L, and businesses that can, to Jim's point, either use automation or just have a smaller, more easier prep kind of menu to really minimize your peak hour labor force. Those guys are going to win. I mean, some of the biggest brands through the pandemic, 4, maybe 5 people at peak hour. That's what they needed. And those guys just drove cash flow all year long.
Yeah. I talk to operators all the time that have said that very same thing, is that the labor force has completely shifted. How they're using labor now is completely different than what it was just 12 months ago.
Yep.
All right, so Chad Spaulding, Jim Balis, both from CapitalSpring. Great having you guys on the session today. Great insights. Thank you so much for joining. We love it, and we definitely want to get you guys back on soon.
Thanks a lot.
Well, thanks for having us, Paul.
You bet. All right. So we're wrapping up Fast Casual Global here today. As you guys know, we're going to be doing more of these events. We'll actually have one in May coming up, and so be on the watch for that date. And, we'd love to get your feedback on all of the things that we're doing here at Foodable, and also kind of how our virtual events are working out for you. Hopefully this is education and insights that's helping your restaurant business grow. Always send us a note to producer@foodabletv.com. Hit us up in the chats on the virtual events, and you can hit me on Twitter @Paul Barron. We'll catch you next time on one of our virtual events right here on Fast Casual Global.